My name is John Arndti, and I'm a financial advisor and partner with Caliber Wealth Management. And first and foremost, we just want to thank you for being here. We have a great lineup, myself not included. We actually have two pretty professional speakers that are going to be joining us, Michael with American Century and Christian with Janus. So I'm going to go ahead and start off with the first part of the presentation. And it is a general market and economic update. All right, so we'll start off with the economy. This chart is the U.S. GDP going back to the year 2000. So if you look at this dotted blue line, it is averaged, the U.S. economy has averaged GDP growth of 2.1%. So how does that compare to what we've done recently? Well, if you remember, the first quarter of this year, we actually had declining GDP growth. So the talk at that point was, are we headed for a recession? And a lot of people said, yeah, we are in a recession, and not technically we weren't, but we did have declining GDP growth. But what happened in the second quarter is GDP growth actually rebounded very strongly. We had 3.8% GDP growth in the second quarter, which is well above that 25-year trend of 2.1%. Third quarter GDP is not out yet, but it is projected right now to be around 3.5%. So that would be 2 quarters in a row where economic growth has been stronger on average than it's been the last 25 years. So that's all good news. So the big question remains, what's going to happen going forward? Our projections are the economy is going to slow down in the fourth quarter. It's going to speed up in the first 2 quarters of next year, and then it's going to start to slow down again. So what's the reason for that? The main reason are the impacts from the tariffs. And so what happened with tariffs were a lot of corporations and businesses front ran the Trump administration tariff announcement. So the end of last year, the first part of this year, they built up all their inventory. So anything they wanted to order from overseas, they bought it, they shipped it over so they could avoid the tariffs. What's happened now is all that excess inventory that was built up has been bought. Everybody's been spending money, so there's no more inventory. So now when businesses and corporations go to buy their new products overseas, they're actually going to have to pay those tariffs, and corporations and businesses are going to raise the prices of those things. So we expect that to cause a slowdown. Now, what causes the speed up in the first quarter and second quarter of next year actually has to do with the one big beautiful bill, which still cracks me up to say that. But the one big beautiful bill is going to provide an enormous stimulus to the economy in the form of tax refunds. So the projections right now for the average American, they're going to get large refunds. And if you look at what builds or what makes up our economy, these are the different areas of our economy. This big blue part is consumption. It's you and I buying money or spending money on goods and services. It makes up 68%, or roughly 2/3 of our economy. So what does the average consumer do when they have more money or they get a tax refund? They go out and spend it, right? Travel, go out to eat, buy a new car, so on and so forth. So that should cause economic growth to reaccelerate in the first and second quarter. And then once that wears off, people are out of their tax refunds, they start to slow down spending, and that will cause the economy to slow down. Not a recession slowdown, just slower economic growth than what we've experienced the past 2 quarters. So what's going on in the jobs market? Right now, the unemployment rate is about 4.5%. Wages are growing pretty good. But what's happened in the last couple of months is we have seen jobs growth slow dramatically. And so it used to be after COVID, even several years after COVID, job openings available were about 10 million jobs. So there were corporations and businesses that were looking to hire 10 million people, and they just couldn't find those. Well, what's happened as they've hired people is those job openings have slowed down, and businesses and corporations just aren't out there hiring as many people. So that's one component to it. The other part of it is immigration. So illegal immigration has come to a halt. A lot of numbers indicate there's literally zero illegal immigration anymore. But also legal immigration and visas that have been issued, that is down as well. So we don't have as many people coming to the United States legally as had been in the past. The projections going forward are for about 250,000 people to immigrate legally here per year going forward over the next year to 2 years. Compare that to the average over the last 20 years, we've had 1 million people immigrate here per year. And so what that means is there's far fewer workers available in the United States to fill these jobs. So even though we expect jobs growth to slow down considerably, we don't expect the unemployment rate to rise because there's just not enough people to fill those jobs that are available. So that's kind of why the Fed has been not as aggressive lowering interest rates, because we haven't seen a spike in unemployment, and inflation, which we're going to talk about next, is still relatively high. All right, so here's a chart on inflation. This goes back to January 2018. Don't worry about all the colors. That's the different parts of inflation or the different components of inflation. We measure inflation, or inflation is measured by CPI, or Consumer Price Index. And you can see, we all remember this vividly, even though it was over 3 years ago, June of 2022, CPI, or inflation, peaked at 9.1%. It's crazy. But since then, for the most part, it's been trending downwards. That is until recently. So it looks like back in April or May, inflation kind of bottomed. And today, inflation is around 2.9%. And because of the tariffs, we actually believe that inflation is going to continue to rise through the first part of the fourth quarter of this year and the first part of next year. We do think, just based on everything that we're looking at, inflation could peak out around 3.7 or 3.9%. So a combination of the tariffs, as well as I mentioned earlier, all these tax refunds, people are going to go spend money. Well, if there's not enough stuff to buy, it's going to cause inflation. So a combination of those things are going to continue to raise inflation to between 3.7, 3.9% through the first half of next year. And then that should start to decline as the economy slows down and head towards the 2% Federal Reserve inflation target. So you might hear the Federal Reserve talk about inflation. They have this arbitrary number that they want inflation to be 2%. And so, again, that's one of the reasons that they've been somewhat hesitant to lower interest rates, is because of what we see right here. Why would they lower interest rates when we're starting to see inflation pick back up? So that's the big question. Now onto the stock market. Who's been paying attention to their accounts recently? Who likes what they see? Yeah, me too. So this is a chart of the valuation of the stock market. So it's not the stock market. What it tells us is how expensive or how cheap is the stock market trading. So this is the S&P 500. It's the most widely known index. It's 500 of the largest companies in the United States. And this chart goes back to 1994. So basically 30 years of data that we have. Now, the valuation metric that we use to determine are stocks cheap or are they expensive is what's called a price-earnings ratio. And the 30-year average is about 17.1, okay? Now, you can see that there are times when stocks are expensive. This is the technology bubble or dot-com bubble. Stocks are cheap. This is 2009, okay? Then it started to trade higher. This is right before COVID. And then here we are today. This is the second most expensive valuation for the stock market that we have seen since the dot-com bubble, okay? So that's not concerning in and of itself, but it just tells you that there's a lot of optimism and hope that's built into the stock market right now. People feel pretty good by and large. The economic numbers are okay, unemployment's low, Inflation is reasonable. It's not as low as we'd like it, obviously, but it's better than 9.1% as it was in 2022. So what does investing in an expensive stock market mean? Well, over 1 year, it really doesn't matter that much. So they're looking at all these different one-year returns based on the PE ratio, okay? So one-year returns, you can see several instances here where the stock market still had really good gains. For instance, this one right here, the stock market was at a PE of, say, 22. There was a 40% return in the stock market that year. So over 1 year, looking forward, high valuations or an expensive stock market doesn't necessarily mean that it's not a bad time to buy stocks. However, if you look at 5-year returns, and here we are right here, there aren't many dots that have really high returns. So what we would say from that is just know that we're getting really good returns, and we have the last several years. The last 3 years have been phenomenal in the stock market. What we should be more concerned about is what do those returns look like over the next 5 years. A little bit more on the stock market. So breaking this down a little bit deeper, the top 10 stocks in the S&P 500 are the most expensive. According to this measure, again, a 30-year measure, those stocks, those top 10 largest stocks, think of your Apple, Nvidia, Google, Meta or Facebook, Amazon, all those stocks are trading about 46% premium to what their 30-year average is, okay? Now, the rest of the 490 companies in the index are, I say, only trading at a 24% premium. And so what that means is that we should be looking at selling some of the top 10 largest stocks that have done so well, and that's really hard as an investor to do, right? It's like, why do I want to sell these stocks that have made me all this money? But what we should be doing is looking at going forward, what are our expectations? And we would expect that these more mid-sized or smaller companies should perform better going forward. And then this chart over here on the right looks at what's called the weighting of all the companies in the market. The top 10 stocks in the S&P 500, again, 500 companies, the top 10 represent 40% of the weighting in that index. So when you see Nvidia or Apple have a huge earnings bump because they announced earnings, that's going to pull that entire index up. So 40%, and historically, the numbers don't get much larger than that. So that is something that we're paying attention to as well. So then the question is, well, why is the stock market doing so good? Who in the room's heard of AI or artificial intelligence? Yeah, you can't turn anywhere these days without hearing about it, right? Well, this chart shows the amount of capital expenditures or spending that businesses are doing on AI. So just look at those numbers. They're staggering, okay? Look at that. Now, these are the real numbers right here in the dark gray. The striped gray lines are the projections for that. So there are a lot of estimates, a lot of optimistic estimates as far as what does AI mean or what does this AI infrastructure build out look like. There are people that are saying $1 trillion per year over the next 10 years is going to be spent on data centers alone. So there's just an unbelievable amount of investment that's taking on. And then this chart looks at what are companies spending money on. So this dotted line right here represents the launch of ChatGPT to the public. So since that point, you can see these things like communication equipment, semiconductors, and computer equipment have just gone crazy. Everybody's spending money on that kind of stuff. Everything non-tech related since ChatGPT is basically flat. So the reason that those top 10 largest companies, most of them involved in AI, that's the reason they have done so well is they're making a huge amount of profits off of all of this spending in technology. Now, the good thing with AI is what's called labor productivity. So productivity is just how much can one worker produce? How productive are they? And so this goes way back to 1885. We don't need to worry about that. Very volatile chart, obviously. But you can see, here's the housing bubble in 2007. Productivity has been on basically a decline over the last 17 years during that period. Well, here is early AI and the spike that we've seen in productivity since then. So that is the reason that businesses are focused so much on AI and how they can utilize that to make their companies more productive and more profitable. And then this chart looks at the types of companies that are using AI to produce goods and services. The light blue line is the percentage of companies that used it in 2023. The dark blue line is the percentage of companies that used it in 2025, September 2025. And then the gray lines are over the next 6 months. So you can see it's not all created equal. If you look at manufacturing, it's a pretty small percentage. But depending on what industry you are in, businesses are spending a lot, using a lot of AI, and they have plans to increase that even more. All right, so one of the more interesting dynamics in the market this year is the US dollar. Probably doesn't get paid attention to a lot on CNBC or Fox Business, whatever you watch. But the US dollar just had its fastest and strongest decline in 60 years. It's down 10% year to date. And there's a number of different reasons why that could happen. First and foremost, the United States has been lowering interest rates. Other countries around the world have not as much. So other countries, whether it's an insurance company in Germany that used to buy US government debt, now they might as well just buy their own government debt in the euro. So that could be it. The other part of it is the trade, our trade deficit. So our trade deficit, you can see when we've seen this sharp decline in the dollar, was the exact same time that we saw the move in the trade deficit. So we think that, in our opinion, that's probably the cause of the move. This is really just on bonds and interest rates. Right now, we feel that interest rates are pretty much fair value. So the yield on a 5-year treasury is about 4.37%, and that's about what you should expect to make over a 5-year period. So this is just telling us that there's still a lot of uncertainty in the credit markets and the bond market. People aren't really taking huge bets one way or the other if interest rates are going to go down or if they're going to go up. And the reason is because of the things that I pointed to earlier, are inflation and unemployment. If inflation starts to moderate and gets down closer to 2%, the economy slows, the Fed's probably going to drop rates. If inflation picks up and gets to 3.9%, the job market's doing okay, consumers are spending money, you could actually see the Fed raise rates depending on what their outlook is. So there's really not, there's kind of a neutral view on bonds and fixed income at this time. And then the last slide I'll share is just looking at what we call global equity valuation. So I spent a lot of time talking about the US stock market being overvalued. Well, what if we look around the rest of the world? So these are several of the largest stock markets in the world: the United States, Japan, the Eurozone. Emerging markets would be like India, not China in this case, Brazil, Eastern Asia, and then China. The dark gray line tells you the range of valuation that each of these markets has been in over the past 20 years, okay? So the top of this, you can see the purple line, or the purple diamond, is where we are today. Just as I mentioned earlier, the stock market is the most expensive it's been in the past 20 years. This would have been back in 2008 and 9 when stocks were incredibly cheap, okay? Well, what you notice in all these other countries is their purple diamond, where their markets are trading today, are nowhere near the upper level that they've traded at before. So what that tells us is that even though they're maybe not trading at a discount, they're still nowhere near up here, and they could provide some decent upside. So we're recommending people keep an allocation to international stocks. Going back to the dollar, when the dollar declines, that's actually good for US businesses because it's cheaper for other countries to buy our goods when their currency is more expensive. So it actually helps earnings. and it helps returns on international markets. So we're continuing to add international markets. They haven't been a great place to be over the last 15 years, but this year, international markets have been some of the best performing indexes. So emerging markets, for instance, up 30% year to date. The S&P 500 here in the US is up 15, so twice the return. The Eurozone, which is surprising to a lot of people, up 25 to 27%, depending on what country you look at. So not having international stocks in your portfolio can hurt when those types of countries and indexes start to outperform.